All right, finally, the last part of our budget assignment. Thank you for sticking with me through all of this. The last thing we need to do is a budgeted balance sheet, and there are a few common things that make our budgeted balance sheet not balance. Something that doesn't balance cannot be a balance sheet. To simplify things somewhat, I'll go ahead and copy and paste these cells and just delete the numbers. Just to save a bunch of typing. All right, so let's make sure that we know where these numbers come from. So as of June 30th, what are the balances in these accounts? Almost all of these we've already figured out. The only one we haven't done everything for is property and equipment, and we haven't done anything for retained earnings, but we'll get there. So cash. What's our cash balance at June 30th? Well, hey, guess what? We've already done a cash budget, figured out our June 30th cash balance, which is also our end of the quarter cash balance. Either one of these gets the job done. So our cash balance as of June 30th, we know is $225,300. Accounts receivable. Way back in part 2 or 3 of this video, we figured out how much our June 30th accounts receivable is going to be. Remember, accounts receivable is the amount that we've sold that we've not yet collected. As of June, we will have had 10% of May's sales that are still not collected, and we're going to have both 30% and 60% of June sales that are not collected. So we're going to have a total of $782,600 of sales that we've made that we haven't yet collected by the end of June. That will be collected in July and August. Inventory. What's our ending inventory at the end of June? If you remember from our merchandise purchases budget, one of the things that we had to figure out was how much inventory do we want to have on hand at the end of the month. And what we decided is at the end of June, we want to have $70,000 of inventory on hand to support our expected July sales of $280,000. So we can take our June inventory on hand and drop that into our balance sheet. That's how much we're going to have. Property and equipment. This is one thing that we haven't really done anything with. We've done a little bit with, we haven't put all the pieces together. How does property and equipment work? You have what you have at the beginning of the period. You add anything that you buy, you subtract anything that you get rid of. And in this case, for simplicity, because this is not an example about depreciation, we've got the property and equipment and the accumulated depreciation netted together. So what we need to do is we need to take our beginning balance of property and equipment, $950,000. We're going to add to it the amount of equipment that we've purchased during the period, $56,000. So that gives us the increase in cost. And we also want to subtract from it the amount of depreciation to increase our accumulated depreciation. So we've got our beginning balance plus the increase of purchases minus the decrease depreciation. And so our ending balance in property and equipment is $964,000. And if we add those guys up, our total assets are $2,041,900. Now, it should be the case that our liabilities and equity balance out. Let's see. Accounts payable. What's accounts payable? Accounts payable is the amount that we owe our suppliers for items that we've purchased and have not yet paid for. The only thing that we don't pay for in the same time period that we receive it is our merchandise. And we have the 65% of June's purchases that we have not yet paid for at the end of June. And that's that number $299,000 that we figured out back in step 4, I think, of this process. So our accounts payable is $299,000. Our common stock, the beginning common stock was $800,000. We were not told of any common stock transactions, so that's going to stay the same. And then retained earnings is the other thing that we need to calculate. And I'll schedule this out because students sometimes struggle with retained earnings. Retained earnings is the earnings or the profits that have been retained in the business. So what we need to do is we need to add up all the net income that's ever been earned. But why would it be not retained? What would we do with it if we weren't keeping it in business? If we're paying dividends out to the owners, we're giving them their earnings back, and it's no longer retained in the business but given back to them. So what we need to do is accumulate our retained earnings over time. We start with $692,000. That's our balance as of March 30th. What did we do to increase retained earnings during the quarter? We earned income of $262,900. We also distributed $12,000 of earnings back out to the owners of the business in the form of dividends. So as of the end of the period, we have $942,900 of earnings that are still retained in the business. So we can drop that number in there. And it should be, if I've done everything correctly, it should be the case that our assets equal liabilities plus equity, and they do. I feel better about that than you probably know. So it is good that our assets, liabilities, and equity balance. Like I said, almost all these numbers are things that we figured out in the planning process to come up with our budget. We not only planned the activities of sales and expenses and things like that, but in doing so, we also plan what resources we'll have on hand, cash and inventory and equipment and things like that, what claims to future cash we're going to have in terms of accounts receivable, the obligations we'll have to our suppliers in terms of our payables, and the net effect of how much we've achieved our organization's objective, how much profit we've earned in retained earnings. Now, if your balance sheet doesn't balance, there are generally 2 or 3 places that you want to look. The first thing that you want to look is make sure that your June 30th make sure your cash budget works. Make sure your June 30th cash is equal to your quarter ending cash. That's what we have up here. These 2 columns should end in the same number. All right, that's one thing. If not, you've got a problem further back, but you want to make sure you use the right one. For accounts receivable, make sure all accounts receivable are included. If you look at our particular setting here, we collect cash over 3 months. Some of it's collected in the month of sale. There are 2 future months worth of cash collections that need to be included in accounts receivable at the end of every month. What we have here is we have both a portion of May and, in a sense, 2 portions of June sales that are uncollected at the end of June. We've got both the we've got both the 60 and the 10% of June and the 10% of May. So there are, in a sense, 3 portions of sales that were not collected at the end of June. We need to make sure we include all of those. Inventory, again, make sure your quarter end isn't a sum. Your quarter end is just, where did it go? Here it is. It's just the $70,000 from June 30th. So make sure your quarter end equals your month end. And same thing with your beginning balance. Make sure your quarter beginning balance equals your April beginning balance. For property and equipment, make sure depreciation is right. By that I mean make sure depreciation is not included in your cash budget. Our operating expense number is a number that excludes depreciation. But make sure your income statement number does include depreciation. Depreciation is one thing that students get wrong very frequently as they're working on their balance sheet. Accounts payable, again, make sure all accounts payable are included. In this case, we only have 1 month's worth of future payments to include, so it's unlikely in this example you're going to make that error. A common stock usually shouldn't change, and retained earnings, make sure dividends are included. That's one of the most common errors I see as students leave out their dividends. If all those things are right, your balance sheet should balance. You could just always have a math error or a formula error or something that's just sort of a typo or something like that. And those are hard to find. Those are hard to nail down. You just sort of need a lot of coffee and a diligent eye to look for those. But these are the accounting problems that tend to show up to make a balance sheet not balance. Thanks very much.